Hello and welcome to our sixth lesson. In previous lesson, we learned about terms used in stock market. Therefore, today we will look at financial statement analysis and financial forecasting. Under this topic, we'll briefly look at users of ratios. Therefore, financial analysis is a process by which an accountant or finance manager or any other interested party identifies the financial strength or position of a company by comparing the relationship between items in the balance sheet and those in the profit and loss account. Thus, financial analysis is of paramount importance to all parties with a financial stake in the company, as they will use such analysis to gauge the profitability and safety of their stake in the company. These parties can be grouped into the following classes: shareholders, who are the real owners of the company on credit; creditors, who supply goods to the company on credit; lenders, who supply the company with loan finance; directors and management of the company; potential investors who may want to invest in the company; the general public, who may include customers, competitors, the government, and extra. Financial forecasting is the process of using past financial data and current market trends to make educated assumptions for future periods. It is an important part of the business planning process and helps inform decision-making. Effective forecasting relies on pairing quantitative insight with creative evaluation. Taking what you know and what you believe could happen near term, you can plan for what comes next. Forecasting factors in expected events, such as predictable economic changes or business expansions. It also attempts to establish contingency plans for unforeseen events, such as stock market corrections, natural disasters, or long or short-term business disruptions. While forecasting cannot predict or avoid every pitfall, for instance, a global pandemic, it can ease the impact of outlier events and create opportunities for growth during advantageous periods. Let's now look at importance of financial forecasting. Importance of financial forecasting are as follows. 1. Facilitating planned, consistent growth. Successful growth shouldn't be left to chance. Forecasting models grounded in solid data and assumptions can offer insights to create cost-cutting and growth opportunities. This can help you optimize spending, so more of your dollars go into revenue-generating activities. 2. Improving risk evaluations. Part of financial forecasting includes finding ways to mitigate unforeseen circumstances and create contingency plans for outlier scenarios. While you can never fully mitigate risk, imaginative scenario building can reduce liability and improve recovery from unforeseen financial events. 3. Informing strategic decisions. With access to data and a well-reasoned future plan, stakeholders can make better decisions about the strategies and investments they make. Forecasting is the way to ensure that decisions are made based on accurate historical data and properly modeled future potential. 4. Providing the basis for budgeting. As we said before, forecasting and budgeting are often used interchangeably, but in reality, they are two separate processes with different goals. Forecasting is the first step of overall financial planning. It considers known data and uses that to predict and influence future unknown events. Let's now finish our lesson by looking users of ratios. The users of ratios include 1. Investors. Concerned with the security and returns of their investments, investors use financial ratios to evaluate earnings per share, return on investment, and return on equity. 2. Creditors. Short-term creditors use financial ratios to assess a company's liquidity and ability to pay its debts on time. 3. Management. Managers use financial ratios to analyze, control, and improve a company's operations. They use ratios to determine how effectively assets are being used and to compare their company to others in the industry. 4. Financial analysts. Financial analysts use financial ratios to evaluate a company's financial and operating aspects. 5. Competitors use financial ratios to analyze a company's financial performance. 6. Tax authorities use financial ratios to analyze a company's financial performance. 7. Regulatory authorities use financial ratios to analyze a company's financial performance. 8. Industry observers use financial ratios to analyze a company's financial performance. 9. Employees use financial ratios to analyze a company's financial performance.